Good day, everyone. This is Geraldine M. Arguelles. Today, our group is assigned to discuss and elaborate the definition and other topics related to insurance. First, I will discuss the nature of insurance. What is insurance? Insurance is a contract of reimbursement. For example, it reimburses for loss from specified perils, such as fire, hurricane, and earthquake. Insurance is provided through a system which makes large financial losses more affordable by pooling the risk of many individuals and business entities and transferring them to an insurance company or other large group in return for monetary payments. A brief survey of insurance literature reveals differences of opinion among authors concerning how the term insurance should be defined. Regardless, however, the literature agrees that insurance has to contain both of the following elements. First is the risk pooling and second is risk transfer. Next is the elements of insurance. Risk pooling or loss sharing. In general, the bulk of the premium required by the insurer to assume risk is used to compensate those who incur covered losses. Loss sharing is accomplished through premiums collected by the insurer from all insureds, from those who may not suffer any loss to those who have large losses. In this regard, the losses are shared by all the risk exposures who are part of the pool. This is the essence of pooling. Risk transfer. Insurance is created by an insurer that, as a professional risk bearer, assumes the financial aspect of risk transferred to it by insureds. The insurer assumes risk by promising to pay whatever loss may occur. In return for accepting this variability in outcomes, the insurer receives a premium. Through the premium, the policyholder has paid a certain expense in order to transfer the risk of a possible large loss. The insurance contract stipulates what types of losses will be paid by the insurer. There are 6 types of insurance. First is sharing of risks. By nature, insurance is a device of sharing risks by large number of people among the few who are exposed to risk by one or the other reason. Second is cooperative device. If a large number of subscribers to insurance serve the purpose of compensation to few among them exposed to uncertain risks, appears as cooperative look. Third, valuation of risk. Valuation of risk is determined as predefined terms and conditions of the insurance policies. Fourth, payment made on contingency. Insurance provides facility of financial help in case of contingency. Fifth, amount of payment. However, it depends on the value of insurance for which payment is made in case of contingency. This provides basis of the amount to be paid. Insurance is not gambling nor charity. Insurance is a policy regulated under laws, and therefore the amount of insurance can neither be paid as gambling nor as charity. There are 3 most common types of insurance. First is property insurance, second is liability insurance, and third is life insurance. Property insurance. It provides coverage for real and personal property owned by a business or an individual. Property insurance is also part of automobile policies covering damage to the car caused by an accident or by other events such as vandalism or fire. For example, many basic homeowners policies cover damage resulting from the following types of perils, such as fire and lightning, windstorm and hail, explosions, riots and civil commotions, aircraft and vehicular accidents, smoke, vandalism, and malicious mischief, theft and breakage of glass that is part of a building. Next, liability insurance. It has taken on great importance for both individuals and businesses in contemporary society. Liability insurance covers specific types of legal liabilities that a homeowner, driver, professional, business executive, or business itself might incur in the round of daily activities. And businesses, professionals, and individuals typically acquire liability insurance for driving-related activities as part of their automobile insurance. In all cases, liability policies cover not only any settlement or award that might ultimately have to be paid, but also the cost of lawyers and related expenses in defending any claims. Lastly, life insurance. As with property insurance, whoever takes out of a life insurance policy on a person's life must have an insurable interest. Everyone has an insurable interest in his own life and may name whomever he pleases as beneficiary. The beneficiary need not have an insurable interest. A spouse or children have an insurable interest in a spouse or parent. Likewise, a parent has an insurable interest in any minor child. That means that a wife, for example, may take out a life insurance policy on her husband without his consent. But she could not take out a policy on a friend or neighbor. As long as the insurable interest existed when the policy was taken out, the owner may recover when the insured dies, even if the insurable interest no longer exists. Thus, a divorced wife who was married when the policy was obtained may collect when her ex-husband dies as long as she maintained the payments. Now, let's move on to the characteristics of insurance. First, it is a contract for compensating losses. Premium is charged for insurance contract. The payment of insured as per terms of agreement in the event of loss. Fifth, it is a contract of good faith. It is a contract for mutual benefit. It is a future contract for compensating losses. It is an instrument of distributing the loss of few among many. The occurrence of the loss must be accidental. And lastly, insurance must be consistent with public policy. Functions of insurance. Primary function: provision of certainty of payment at the time of loss, and provision of protection risk sharing. Secondary function: prevention of loss, provision of capital, improvement of efficiency, and ensuring welfare of the society. How insurance works. Insurance works through the following steps. First, risk is transferred from an individual or entity to a third party. The third party pools all the risk exposures together to compute potential future losses with some level of accuracy. The insurer uses various forecasting techniques depending on the distribution of losses. The pooling of the risk leads to an overall reduction of risk in society because insurers' accuracy of prediction improves as the number of exposures increases. Insurers pool similar risk exposures together to compute their own risk of missing the prediction. Insurers discriminate via underwriting, the process of evaluating a risk and classifying it with similar risks. Both the transfer of risk to a third party and the pooling lead to reduced risk in society as a whole and a sense of reduced anxiety. Key points. Insurer is the company or person who promises to reimburse. Insured, sometimes called the assured. It is one who receives the payment, except in the case of life insurance, where payment goes to the beneficiary named in the life insurance contract. Premium is the consideration paid by the insured, usually annually or semi-annually, for the insurer's promise to reimburse. The contract itself is called the policy. The events insured against are known as risk or perils. And that's all for the nature of insurance. Next, my group mates will discuss the regulatory bodies of insurance. That's all. Thank you for watching.